welcome to another edition of Let's Talk Money with me, Surabhi Upadhyay. Now, we always pay plenty of importance to the equity part of our portfolio, the right stocks to own, the right funds that we must have. But do we pay enough attention to the fixed income or the debt side of things? Perhaps not. Many of us are perhaps quite happy with our fixed deposits, and we leave it at that. Pretty much that's that. But is there a need to rethink our debt investment strategy? Should we be moving beyond FDs? And if yes, what sort of debt funds and even direct bond investments perhaps make sense in the present market environment? Well, that's the topic on the show today. And to discuss this and to answer all of your questions, I have with me Vishal Goenka of IndiaBonds.com and Mohit Gang of Moneyfront. Gentlemen, thank you so much. Great to have you in our studios on a topic that I confess is not discussed perhaps as much as equities. But it really got me thinking when we were thinking about having a conversation on fixed income, that perhaps it requires a deeper thought. Mohit, why don't you go first? I know we've had umpteen number of equity mutual fund conversations, but what are clients telling you? Is there an evolution happening towards making your debt portfolio?
Look, to be very honest, Surabhi, I think it's been a while that I have had clients proactively coming back and asking for fixed income options. The run-up in the equity markets is so crazy that obviously people have kind of kept it at the back burner. Though as advisors, we make a very conscious effort to keep reiterating the fact that asset allocation is the most crucial component of the entire portfolio. And perhaps fixed income deserves a lot of merit, and more so right now, in the way the yields are and where we are positioned in terms of the rate cycle and perhaps the inclusion of India into the JP Morgan bond index and Bloomberg index, so on and so forth. So a lot of action is going to happen on the bond side. And I think, genuinely, I think people should pay attention to the fixed income part of it.
Absolutely. And I'm glad you brought this up, because if the foreigners are going to come in and buy our bonds, and as Indians, why shouldn't we own more of them, right? So that's a great point. Vishal, as we get started, let me tell our viewers that, of course, IndiaBonds is one of those platforms where you can actually go and directly buy bonds right now. And that's not a marketing statement I'm making. It's just for information. But Vishal, as someone who's watching this market sort of grow and evolve, do you really see a lot of takers, at least at the retail level, people who generally want to go and buy a bond for their portfolio?
No, I think the educational awareness or the financial education awareness in this country has really gone up. So people do realize they need to diversify their portfolio. If I have 1 lakh or 10 lakhs or 1 crore, I cannot put everything in equity markets. People did not have access before this. They did not know where to go, where's the information, what is an information memorandum, credit rating. So I think that dramatic change is happening, thankfully, to the SEBI regulation around online bond platforms. So we do see people are buying 10,000 rupees of bonds, people buying 1 lakh, 10 lakh on a platform, even to up to 1 crore. So the fact that you can actually invest in bonds directly has been a changing scenario for people's portfolio.
Oh, absolutely. So, gentlemen, I want to really, make the most of this classroom and start with very basic grassroots level concepts that we should bear in mind whenever we're thinking fixed income, right? By nature, whether you're investing in a debt fund or a bond directly, or even a Government of India security, essentially you're buying a security where, someone is offering the promise to give you the money back. That's essentially what debt is all about. Let's start with the concepts. As fixed income investors, what is it that we should be aware of? Shall, the onus is on you. Now simplify that even further. The concept of accrual, the concept of credit, and the concept of duration.
So as you said, what is a bond? A bond is you have lent money to somebody who gives you a rate of interest in exchange of that, and a promise to return your money after a certain period of time. So accrual is nothing. Accrual is the fact that you're earning interest on the loan or the money that you have given to somebody. The duration is obviously what is your investment objective? Do you need money invest for 1 year, 3 year, 5 year? Talking on Mohit's point, the longer you invest for, more risky your asset is. So one aspect, which is the risk to keep in mind, is interest rate risk.
Absolutely.
If absolute interest rates go lower, which is what India is looking at right now, you can actually also make capital appreciation on your bonds. Right? So, to his point, accrual is important, duration is important, and of course the credit risk. If you give money to the Government of India, it is the safest, it's called risk-free. But if you're giving money to a public sector or a bank or a state guarantee or private entity, so the risk metric which is judged by credit ratings from AAA, AA, single A, you get higher returns for taking more risk.
Absolutely. So just keep these concepts in mind because we will come back and we'll revisit them. We'll give you more details on them. And also we need to bear in mind, Vishal just mentioned that as interest rates start going down, you could get capital appreciation. And that's, again, I'm just reiterating a very fundamental principle. There's as rates fall, typically bond prices rise. And that rise in prices is what leads to a capital gain, which is possible in fixed income. More on this as we go along. But let's also get some of the viewer questions in. We have Rajesh with us on the phone line. Rajesh, welcome to Let's Talk Money. Tell us, what's your question?
Hi, this is Rajesh. I'm 59 years old and I have most of my investments in equity and gold. I would like to diversify into debt and fixed income in order to have a steady income for my retirement years. Where should I start? I have some investment in public provident fund already.
Okay, great, Rajesh. Thank you so much for joining us on the show. And I think your query is the query of the nation. Maybe I can say that because a lot of us already have investments in either fixed deposits or some of these, small saving schemes or the employee provident fund.
Right.
The question is there a need to now think beyond that? Mohit?
Oh, totally. Totally. Like, I think one has to go beyond the PFs and the normal PPFs and the Sukanya Samriddhis and the NSCs of the world. Though I understand NSCs and KVPs are out of equation now. But even the other instruments, look, I understand they give you tax-free returns, which is a massive, massive thing in the world of debt. When you're getting 7.1% on your PPF and you're getting 8.25 on your PF, I think that's a fantastic
And
return.
those are the only two ones which will not tax you even when you're withdrawing the money at
Even
the end
Sukanya
of it.
Samriddhi.
Even
8.2,
Sukanya Samriddhi.
Even Sukanya Samriddhi at 8.2, I think these are fantastic instruments.
So you would, advise putting aside some money in
Always,
these?
always.
Okay.
Just let your PF corpuses go on. Just continue the PPF. Though the shortcoming out there is you can only put in 1.5 lakhs every year. But I think these are fantastic instruments which all of us should do.
Okay, so those are, the steps that you would advise.
Yeah.
Go with small saving schemes which give you the tax advantage, like the EPF or the PPF. Look at certain debt funds and then venture out into direct bond investing as well.
Totally.
Got that. Just contrast the two because the other fact of life, Vishal, is that a lot of retail investors also want to try things on their own.
Yes.
Maybe they're very eager, especially maybe youngsters are very eager to jump the curve that, our friend Mohit just pointed out here. Now, should one even consider that, or could that get really risky if you start buying bonds directly?
No, absolutely not. So firstly, I want to congratulate Rajesh. At 19 years, he's thinking about regular income for retirement. So that's fantastic.
At 59.
Okay. And thank you. I think you could ideally start with government securities or AAA rated or public sector bonds. So you take away a large factor of credit risk is what takes people time to understand. And I think in this world of do it yourself, you should absolutely go buy a bond directly. The coupon starts coming into your bank account. It adds to your income. You see how it plays out for a year or two. And once you understand, read more about it, the information memorandum, what do rating reports look like, you invest in your own education at a very early stage. But then I would advise starting with government securities and AAA rated bonds and then slightly move into more riskier assets.
So when, again, to simplify for our viewers, when Vishal is saying that there's lesser credit risk in government securities, government bonds, that basically means a lesser chance of defaulting. Credit risk, in very simple terms, is equal to the chance of the bond issuer defaulting. And well, in government securities, it is the sovereigns, the government of India backing that bond. So, absolutely almost nil chances, zero chances of any default happening. Gentlemen, we do have to take a break, but then I want to dive further, deeper into this whole conversation about direct bonds and how and why not. We'll take that break, come back, and we will answer more of your questions on the other side. Welcome back. You're with us on Let's Talk Money. And this week on the show, we're discussing why perhaps there's a need to go beyond lazy fixed income investing in the form of fixed deposits. Why debt mutual funds and perhaps even direct bonds are worth your while. We have a viewer query coming in. Akansha is with us on the phone line now.
I'm Akansha. I want to invest in fixed income securities directly. How does one know how safe a bond is given the fact that frauds have happened earlier despite good credit ratings?
Akansha, thank you for asking that question. You've really taken it, from me literally. And it's very heartening to know that there is that awareness because we've had episodes and not too recent, not too old a past, frankly, which kind of come to mind. So, gentlemen, let's start by, understanding how to evaluate. Like you said, if it's the government of India, we're fine. That's secure paper. But if it is, whether it's state governments, whether it's corporate enterprises, PSUs, how do we know that what is AAA indeed can let us sleep peacefully at night?
I will answer Kanka's question first. Just because, in India, we had a massive credit upheaval since 2017, 18, 19. And yes, we did have some mishaps of companies defaulting. It is absolutely natural to happen in any global cycle. In GFC in 2008, we had AAA securities go defaulted in the US and the Western world. So I think we should just stop beating ourselves about it. Because the country has actually gone through an education cycle. Smart questions like this are telling me that people, thanks to technology and maybe, COVID-enabled kind of self-learning, that people are reading more about it, are more aware of the risk associated. So when you're judging a company, I think, as Mohit pointed out, there's a lot of material you can read, which wasn't the case 2-3 years ago. You can read the information memorandum. You can actually read the credit ratings report, which I don't know was very easily accessible 2 to 3 years ago. So I think we should let the ghosts of the past lie, learn from our mistakes. Equity markets, stocks go up and down 25-30%. People don't stop investing in equity, but learn from it. Yeah. And I think I would encourage that in fixed income as well. And so credit ratings is an important stopper, but learn about the industry, about the company a little more will help you to choose the right issuer.
I remember doing shows at that point in time titled "Is Fixed Income Really Fixed Income?" Right? Because that's what really happened back then. So awareness is really important, and the onus lies on us as investors. Yes. But having said that, let's now move forward and talk about sort of if at all you're looking at direct bond investing, if you have the risk appetite, then how does one do it, Vishal? So I mean, how do you go about it? What's the KYC process? And more importantly, what about regulation? No. Who regulates this? Where do the securities lie? Tell us all.
I think there's been a dramatic change in India last year and a half. So online bond platforms are regulated by SEBI in this country. So the first and foremost thing when you are doing direct bond investments, make sure that the platform that you're trading with is regulated, which means it's a stockbroker and licensed. I think that is very important. Once you become a stockbroker, all the other compliances fall into place in terms of scores, redressal mechanism, a grievance mechanism, etc. So that's the first check people should make about direct bond investments. Secondly, only OBPs can only show listed bonds. Now, what is the difference between
OBP, online bond platform.
Sorry about the jargon. Can only show listed bonds. Now, what is the difference between listed and unlisted bonds? Listed bonds on the exchange have a requirement to report regular financial earnings and disclosures, which unlisted don't. So people should be very careful and ask the question, is this bond unlisted? The third thing, I think fixed income, people are still learning, and there are a lot of fixed income type of securities that are being offered on platforms. So be aware of, structured debt, be aware of, a lot more complex debt before you're investing. But investing online, OBP, online bond platform, SEBI registered, you have a regulator overlooking that and gives you the safety much like equity investing.
Finally, Vishal, quick last word with you. Again, I'm going back to the investor who's taking his or her baby steps now, just getting away from the PPF and the EPF and the fixed deposit. Yes. Just reiterate the route and the red flags we should not ignore along the way.
No, absolutely. I think direct bond investments versus, let's say, other mutual funds, both can coexist. Can give you the ability to earn higher returns, right? Because there's an intermediation cost, there's a management cost which we do away from. Investing in direct bonds is pretty simple. Make sure the platform that you go to is SEBI registered online bond platform provider. KYC on a platform like us is digital and paperless, takes 3 minutes. So you can actually invest in a direct bond in 5 minutes on an online platform. And again, it is under SEBI's regulation, so completely safe and secure. Another fact I would like to highlight, the payment you make on a bond platform, the money actually directly goes to the clearing exchange. So it's in fact one step safer than investing on equity platforms. Things to look out for, make sure there's SEBI regulation, make sure you read the information memorandum and credit rating reports, and make sure you invest in listed bonds.
Okay, gentlemen, thank you very much. I think this is pretty interesting. Lots of thoughts, lots of food for thought, actually, that we're leaving our viewers with. Hopefully, this will invigorate them to go back, talk to their financial advisors, and think whether it's about time that we move beyond the humble and very simple and sweet fixed deposit. Well, with that, we come to the end of this week's edition of Let's Talk Money. Keep sending us your feedback. We'll see you again with another theme next week. Thank you for watching.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.